Hello. Welcome to Mr. C's online lessons. How about that? I actually figured it out after it took far longer than I'm willing to admit. Anyway, so this lesson is going to be about inventory errors. So this is the last lesson of Unit 3. Hopefully you guys have been able to refamiliarize yourselves with the earlier parts of Unit 3. If you haven't, I recommend that you do that first before going through this lesson. But anyway, let's proceed. So, inventory value is basically the cost of goods available for sale, and it can be seen in two ways. The ending inventory, which is what you'll find on a balance sheet, or the cost of goods sold, which is what you'll find on an income statement. Now, the impact of an error can be compounding in a sense, not in so much that it doubles over time, but that an error made in one period can impact another. So we'll get to that in a moment, but a source of error can come from many different parts. It can come from purchases, it can come from the ending inventory of either the previous period or the period that we're currently working in. It can also affect costs of goods sold. And if you make an error in any of these, both financial statements will be affected regardless of which of these sections is affected. So in terms of the balance sheet, the effects of the errors will be felt in both the inventory assets account and owner's equity accounts. As far as income statements go, you'll usually see the errors appearing in COGS and net income. Check page 285 out for an example. I put that there just because it's got a great table that shows sort of the corresponding effects for what happens in different accounts and different elements based on the type of error that's made. You do not need to memorize this. It's an intimidating table when you first look at it, but basically it just shows the repercussions of different errors made in different places. So earlier I said that an error can impact not just the current period that we're looking at. It can carry over into future periods. And the reason for that is, we're going to look at it in a second, but mainly the ending inventory of one period affects the beginning inventory of another period. So there won't just be an error in the period that the error was made, it'll carry over. And that's what I'm ahead of myself. I'm too eager. Okay, but the combined, yeah. So a sort of, I don't know if I'd call it a saving grace, but errors will usually cancel themselves out over a long period of time, usually 2 years. That doesn't mean, however, that the errors don't matter. Accounting is all about giving the most valuable information in as timely and relevant a manner as possible. And despite the fact that errors in inventory often work themselves out over a long period, not always, but often, but that doesn't mean that they don't need to be corrected. So yeah, 285, page 285 is all about income statement stuff. Generally speaking, I wrote this out just to give you sort of the general idea of how the effects of errors ripple out. So overstating ending inventory will result in an understatement of COGS. So you overstate how much inventory you're left with, which means you're understating how much the cost of goods sold was. And in return, because you're understating COGS, you will overstate your net income. Basically, by saying that you have less, it'll look on paper like you're selling more than you actually are. So your income will appear to be higher than it actually is. And the converse is true as well. So the exact opposite of this will occur if you understate ending inventory. Now this is all broken down in the table, and there's more options and ripple effects in that table, so definitely check that out. But I just wanted to give you an example of the kind of info that you want to scoop up from this table. Now page 286 in the book is all about how errors affect the balance sheet. And in this case, the accounting equation is as key as ever. And so in terms, how do I put this? The table that they give you is not an ironclad, it will always be this. It just sort of shows how the general effects work. Because liabilities can be affected by something depending on how and why the inventory was made and what assumptions you're making, etc. So don't blindly follow this table. I mean, it'll usually be right, but you also want to use your understanding of the accounting equation and how things work, and use the assumptions that you make based on costing principles and revenue recognition and all that stuff. Great example for that is the before you go on section on page 287, where they talk about how inventory, 90 grand of inventory was left out because it was still being shipped. And so I won't recite the whole thing. You guys can check that out for yourselves. But that's a great way to show how an error doesn't necessarily come from incompetence. It can just be an error as a result of operating the way you should be operating. So yeah, check that out. Okay, so valuation. So this has to do with the value that you assign your inventory. As you guys know, the value of inventory is not static. It changes over time. And so as accountants, you need to recognize this change in value to a degree. We don't change the value of inventory daily, but over time, some inventory can become more valuable and some can become less valuable. And at the end of a period, or whenever you're applying statement valuation, you need to take a look at the value of the inventory that you have. More specifically, you need to take a look at the market value of the inventory that you have. So this has to do with what's called conservatism. I don't know why I had such a hard time saying that. Conservatism is basically choosing the valuation method that results in the least likelihood of an overstatement of assets. So basically, you're trying to be as conservative as possible, hence the name, and you're trying to make sure that your assets are as accurate as possible. Overstating assets very often resolves in misconceptions that the company is doing better than it actually is, and that's very dangerous. In terms of thinking that your company is capable of more than it is, or you have more cash flow than you actually do. And so it's all about being as accurate as possible, but also being as conservative and insulating yourself from errors as much as possible. Usually when it comes to statement valuation, you use a method called LCM, which stands for lower of cost and market. So basically what that means is you're choosing the lower value between either the cost at which you got the inventory that you're selling, or the current market value of the inventory that you're selling. So initially you cost using the cost principle. You guys know this already. We've already talked about that. But over time, the market value of inventory can replace the cost. Now this would, or it should only happen if the market value is less, hence the lower part of this name. when you change or revalue the inventory that you have, you will arrive at something called the net realizable value. You could think of this as sort of a salvageable profit, if you will. So the net realizable value is the selling price of the assets less the costs required to make the goods ready for sale. And this cost may change depending on the valuation of the inventory that you use. So why do we write down to the lower of cost and market? We do this to follow conservatism. I said that already. Yeah, okay, I'm just repeating myself. My bad. It's an important point that a lot of accountants strictly adhere to. It's just the way to be as accurate and conservative as possible, leaving you less open to errors and more damaging ones, because thinking you're in a better position than you actually are is a very dangerous slope to be on. It's the mathematical and financial equivalent of being very overconfident, if you know what I mean. And being overconfident can be dangerous. So in terms of journal entries, when we do valuations with the LCM principle or method, whatever you want to call it, the way this entry works for the valuation adjustment is this. First, usually if you're doing LCB, well, actually always if you're doing an LCM, there'll be a loss in inventory value, because you're doing this because the market value of your inventory is less than what you paid for it. So essentially you're losing money. So in order to enter this, we debit an account which is called, it's a long name, it's called loss due to decline in value of inventory. Now this is an owner's equity account, and we're debiting that. So hopefully as you guys recall, debiting an owner's equity account reduces its value. So, or reduces the amount of owner's equity, I guess I should say. And the corresponding credit is to merchandise inventory, which, as you know, is an asset account. So whenever you use LCM, there will be a decrease in the value of the inventory. And so we debit an owner's equity account and credit an asset account to represent that loss. Just a note, LCM can be applied to total inventory, but it is more accurate to apply it to individual items. Now, when I say individual items, I don't mean that if you're an electronics store, you don't apply it to each old iPod individually. That would take forever. I mean, you break your inventory up into general products, sort of thing. So you would apply LCM to, say, iPods, then radios, then old cell phones, etc., etc. You wouldn't just do LCM. I keep thinking to say LCBO. You wouldn't do it to your entire inventory. You would just do it for the individual product lines or inventory lines in your total inventory. So an example, an auto dealership marking down last year's models. You might do the general categories differently. You might mark down, an auto dealership is a very specific example because some cars depreciate far more drastically than others. But depending on what kind of merchandise you're selling, you might break this down and apply LCM differently. If you're wondering how to actually apply LCM, if you check out page 288, there's a figure 620. It shows sort of the original cost of several different electronic items and then the corresponding market value that has been adjusted for. So you can see that there. Oh yes, in the income statement, I almost forgot. In the income statement, loss is recorded in an account or an element called other expenses and losses. So that's how you represent the depreciation value or the loss in inventory value. Okay, so statement presentation. So this is the last bit of the lesson. The following information should be disclosed in the notes of a financial statement. So this isn't the notes after an account or an element. This is notes that go at the end of a statement, or it's something you include when you're disclosing a full statement, like a full income statement. So there are three things. So the major inventory classifications. So if you recall earlier when I said that you change the market, or you apply LCM to different classifications of inventory. Well, I said inventory lines. But anyway, so for a dealership, they would disclose vehicles by year and by type usually. Grocery store could do things like produce, dairy, meat, dry goods, etc. And yeah, I mean, this is common sense. You guys know this, but the more classifications you have, the more work is involved. The basics of accounting, cost or LCM. So you want to disclose which method of inventory valuation you used. If your inventory hasn't depreciated, or there is no need to adjust for the inventory's value, then you would just say that you're valuating at the cost principle versus LCM. And the third thing is the cost. Oh my God, this square. Go away! The cost flow method, either FIFO, LIFO, or weighted average, or specific identification. So this is from before the March break. Hopefully you guys remember that. But you want to disclose which inventory method you're using, because there's no way that readers of your statements would know unless you told them. So these three items need to be disclosed at the beginning or the end of a statement, just as little notes. They don't actually go in the statement. They're like accompanying notes, if you know what I mean. And that's it. All right, so we did it. First lesson of online learning. Look at that. I hope you find this useful. Let me know if there's anything you'd like to see changed in the lesson itself. I think this is how I'll broach lessons in the future, if you found it useful. If you didn't find it useful, then we can change that. But yeah, let me know what you think. Hopefully you got some value out of hearing stuff orally, and I hope the audio quality is okay. I don't know why it's so hard to just record a video on a PC. I had to break out my old MacBook and use some really old, outdated software to get this done. Anyways, I hope you guys are doing well. Take care, stay safe, keep your heads up, and yeah, I hope you have a good day. Take care.